Stop scrolling. In the next few minutes, I'm going to reveal the exact roadmap that can free you from the middle-class trap and put you on the path to true financial freedom. This isn't theory or motivational fluff. This is a practical step-by-step blueprint used by self-made millionaires, entrepreneurs and investors to build wealth, escape paycheck-to-paycheck living, and design the life they've always dreamed of. In this audiobook, we dive into 10 powerful chapters that cover everything from escaping the middle-class mindset, stacking high-income skills, building multiple streams of income, mastering investments, leveraging time, networking with winners, and creating assets that work for you, even turning savings into generational wealth. And here's the best part. This video has no ads, so you can focus 100% on learning and implementing these life-changing strategies. Subscribe now, hit the bell, and join our daily audiobook journey. You won't miss a single step toward wealth, freedom, and success. Chapter 1. The Middle-Class Trap. Why hard work alone isn't enough. You wake up every day, go to work, put in the hours, and still wonder why your bank balance never grows, why the debts never seem to disappear, and why financial freedom feels like a dream reserved for someone else. That's the trap most people find themselves in, the middle-class cycle. It's the system that teaches you to work hard, get a stable job, take on loans, buy a house with a mortgage, drive a car with monthly payments, and then spend the next 30 years paying bills and hoping retirement will finally bring relief. The truth is, this cycle wasn't built to make you rich. It was designed to keep you working, paying taxes, and living just comfortably enough that you never break free. Think about it. The middle-class life looks good from the outside. A steady paycheck, weekends off, maybe even a vacation once a year. But when you look closer, you'll realize most of that paycheck is already spoken for before it even hits your account. Rent or mortgage, car payments, insurance, credit card bills, student loans, food, utilities, and let's not forget taxes. By the time all of that is taken care of, what's left? A little left over to spend at the mall, eat out, or upgrade a phone. That's not wealth. That's survival dressed up to look like stability. Let's use a real-world example. Imagine someone making $4,000 a month. Sounds decent, right? But $1,500 goes to rent, $600 for the car, $300 in insurance, $500 for groceries, $400 in debt payments, and another $500 for taxes and utilities. That leaves barely $200 to save, if they even manage to save it. That's the hamster wheel, month after month, year after year. The same cycle repeats, and escaping it feels impossible. And here's the trap. Society rewards this lifestyle. Go to school, get good grades, land a job, pay your bills, and live within your means. That's the formula they hand you. And most people follow it because it feels safe. But safety is often the most dangerous place to be, because safety in the middle class means you're always one emergency away from losing everything. A medical bill, a layoff, an economic downturn. It only takes one hit, and suddenly the so-called safe life collapses. Now let's talk about why hard work alone doesn't fix this. Millions of people work 40, 50, even 60 hours a week, and they're still stuck. You know why? Because wages don't grow the way expenses do. Your salary might go up 3% a year, but rent goes up 10%. Gas prices jump, food costs rise, taxes stay. The harder you work, the more the system takes from you. That's why some people hold down 2 jobs and still can't build wealth. Hard work is important, but if hard work was the secret to wealth, construction workers, nurses, teachers, and delivery drivers would be millionaires. Clearly, it's not about effort, it's about strategy. The wealthy understand something the middle class doesn't. The rules are different, depending on which side you play on. The middle class trades time for money. The wealthy trade money for more money. The middle class focuses on income. The wealthy focus on assets. The middle class saves in a bank account where inflation eats away at value. The wealthy invest in businesses, real estate and stocks that grow faster than inflation. It's not because they're smarter or luckier, it's because they play by a different set of rules. Take taxes, for example. A middle-class employee pays taxes before they even see their paycheck. A wealthy business owner earns, spends on investments, and then pays taxes on what's left. Same law, two different outcomes depending on whether you're an employee or an owner. That's why someone making $80,000 a year as an employee might take home less money than someone making $60,000 through a business. The wealthy use the law in their favor, while the middle class suffers from not knowing how the system works. Another example, debt. For the middle class, debt is a burden. Credit cards, loans, mortgages. It keeps them chained to payments. For the wealthy, debt is leverage. They borrow money not to buy liabilities, but to buy income-producing assets. A middle-class family might take out a $40,000 loan for a car that loses value every year, while an investor takes out a $40,000 loan to buy a rental property that pays them cash flow every month and appreciates over time. Same debt, two completely different outcomes. Escaping the middle class starts with seeing these differences clearly. You can't just work harder, you have to start working smarter. That means shifting from being a consumer to becoming an investor. Instead of upgrading the phone every year, take that money and buy shares of a company that pays dividends. Instead of putting every extra dollar into a bigger car or a bigger house, start building a cash cushion and putting it into assets that generate income. But let's be real, this isn't easy. It takes discipline and a willingness to step out of the comfort zone. It means cutting back on things that make you feel middle-class successful, like the shiny car or the designer clothes, and putting that money into investments that actually move you forward. It means learning skills outside of what school taught you: financial literacy, negotiation, entrepreneurship, and networking. These aren't optional, they're required if you want to break out of the cycle. One of the hardest parts is shifting mindset. The middle-class mindset is about survival and comfort. The wealthy mindset is about growth and freedom. Most people don't escape the middle class because they cling to comfort. They don't want to take risks, they don't want to fail, and they don't want to step into the unknown. But the truth is, staying in the middle class is the biggest risk of all. You'll never own your time. You'll always live on the edge of financial stress, and you'll pass down the same struggle to the next generation. Here's something to remember: no one is coming to save you. Not the government, not your employer, not the economy. If you want to escape the middle class, it's on you. You have to learn the rules of money. You have to start building assets, and you have to break free from the idea that a paycheck is security. Real security comes from ownership, from control, from having multiple streams of income that don't depend on your physical presence every day. Think of it like this: if you stop working today, how long can you maintain your lifestyle? For most middle-class families, the answer is weeks, maybe months. For the wealthy, the answer is years or even forever, because their money keeps working even when they don't. That's the difference. This first step, recognizing the trap, is the beginning of change. Once you see it, you can't unsee it. The middle class isn't failing because people aren't working hard. It's failing because people are playing a game that was never designed to let them win. You don't escape by running faster on the hamster wheel. You escape by stepping off and building your own track. So as you listen to this, ask yourself, are you living to pay bills, or are you building a life of freedom? Are you spending your time and energy keeping up with expenses, or are you positioning yourself to break free and create real wealth? The answers to those questions will determine whether you stay trapped or finally make your way out of the middle class. Chapter 2. Mindset Shift. From Paycheck Mentality to Wealth Builder. Most people are trained from childhood to think in one direction. Go to school, get a degree, find a stable job, and hold on to it for as long as possible. That's the paycheck mentality, and while it feels safe, it's the exact mentality that keeps millions of people stuck in the middle class forever. A steady paycheck gives comfort, but it also blinds you to bigger opportunities. You start believing your entire financial destiny is tied to the hours you put in at work. The moment you stop working, the paycheck stops too, and that dependency is exactly what keeps you trapped. True wealth is not about the size of your paycheck. It's about breaking free from dependence on one paycheck at all. When you meet someone who thinks like the wealthy, you'll notice the difference immediately. While most people ask, "How much does this job pay me per hour?" the wealthy ask, "How can I create value that pays me forever?" That's the shift. For example, a person with a paycheck mentality might work overtime to earn an extra few $100s a month. A wealth builder will instead invest that time into building a small business, creating content, learning digital marketing, or buying an asset that generates money even when they're not working. The first person trades time for money. The second builds something that keeps paying without constant effort. Let's take a simple scenario. Imagine two friends, David and Sam. David works at a corporate job and makes $70,000 a year. He prides himself on his security. Every 2 weeks his paycheck comes in, his bills get paid, and he feels stable. But he's capped. His boss decides when he gets a raise. His company controls how many hours he works, and if layoffs come, his security vanishes overnight. Sam, on the other hand, decides to shift his mindset. He starts a side hustle reselling items online. At first he makes only $500 a month, but he learns how to scale, how to market, and how to build systems. Within 2 years, his side hustle surpasses his job income. The difference isn't intelligence, it's mindset. David clings to a paycheck. Sam builds income streams. That is the dividing line between staying middle class and breaking out. One of the greatest illusions is job security. People stay in jobs they hate for decades because they fear losing the paycheck. But here's the truth. No job is truly secure. Companies can fold, industries can collapse, technology can replace positions overnight. We've seen it in manufacturing, in retail, even in office jobs, where automation has taken over tasks that once required human workers. If your only strategy is relying on a paycheck, you're placing your entire future in someone else's hands. That's not security. That's dependency dressed up as stability. Real security comes when you own assets and skills that no one can take away. Here's a practical example. During the 2020 pandemic, millions of employees lost jobs overnight. Entire industries froze. People with a paycheck mentality panicked because their income source was gone. But those who had already shifted their mindset survived differently. The person who had an online business kept selling. The investor with rental properties still collected rent. The content creator still earned from ads and sponsorships. That's the difference between paycheck thinking and wealth-building thinking. The ability to weather storms because your money comes from multiple directions, not just one employer. The wealthy operate under a simple principle: create systems that pay you whether you're working or not. That might sound out of reach, but it starts small. For example, instead of spending your weekend binge-watching shows, you could spend that time learning how to build an e-commerce store, how to invest in dividend-paying stocks, or how to create a digital product. Those few hours can build something that pays you repeatedly. A paycheck pays you once, an asset pays you over and over. That is the law of leverage, and it's how the wealthy think. Now let's talk about law, because this is where the mindset shift really becomes powerful. Employees earn wages, and those wages are taxed heavily before they even touch the employee's hands. That's the law. But business owners and investors legally play by different rules. They can deduct expenses, reinvest profits, and often pay lower tax rates. Why? Because the law rewards those who create value, take risks, and build opportunities for others. If you cling to a paycheck, you play the game where the tax burden falls on you. If you shift your mindset to wealth building, you step into the arena where the rules favor you. This isn't about cheating, it's about understanding how the system is built. The wealthy aren't smarter, they simply use the law in their favor. Think of someone who earns $100,000 as an employee. After taxes, they might keep only $70,000. Now think of someone who runs a small business and earns the same $100,000. They deduct expenses like travel, marketing, equipment, and even part of their home office. After legal deductions, maybe they're only taxed on $40,000 of that income. They keep more money while technically earning the same. That's not magic. It's mindset. If you think like an employee, you stay trapped. If you think like the wealthy, you learn to play the game differently. Another major part of this shift is how you see money itself. The paycheck mentality sees money as something to be spent on comfort, bigger houses, newer cars, expensive vacations. The wealth builder sees money as a soldier, something that should be deployed to go out and bring back more soldiers. If you buy liabilities, your money leaves and never returns. If you buy assets, your money goes out, works for you, and comes back with more. That's why someone with a smaller income but an investor's mindset can build wealth faster than someone earning six figures but living paycheck to paycheck. Take the story of Maria, a nurse, making $60,000 a year. She used to spend most of her paycheck on lifestyle upgrades. Then she decided to change. She cut unnecessary expenses and invested $500 a month into dividend-paying stocks. In 5 years, those investments started paying her $300 a month in passive income. That $300 didn't require her to clock in, didn't depend on overtime, and didn't vanish if she quit her job. That's what it looks like to escape the paycheck mentality, turning money into workers that never sleep. The mental shift also applies to time. Most people see time as something to sell. They give 8 hours a day to a job and get paid for those hours. The wealthy see time as something to multiply. They build systems, delegate tasks, and automate processes. For example, a content creator can make one video that continues to earn ad revenue for years. A writer can publish a book once and keep receiving royalties. A business owner can train employees to run operations while they focus on growth. That's multiplying time instead of selling it. Escaping the paycheck mentality doesn't mean quitting your job overnight. It means using your job as a foundation to build something greater. Keep the paycheck while you learn new skills, start side projects, and invest wisely. Use the stability to fund your freedom. The trap is staying dependent forever, but the strategy is using your paycheck as seed money to escape it. The truth is, most people won't make this shift because it feels uncomfortable. It requires sacrifice, patience, and stepping into the unknown. But ask yourself this: do you want to spend 40 years waiting for promotions, living off one source of income and hoping retirement funds last? Or do you want to take control now, build assets, and create freedom on your own terms? The choice comes down to mindset. When you stop seeing a paycheck as the ultimate prize and start seeing it as fuel for wealth creation, everything changes. You stop asking, "How much do I earn?" and start asking, "How much can I build?" You stop depending on others to decide your worth and start creating value that the world pays you for, even while you sleep. That's the shift that separates the middle class from the wealthy. Once you embrace this new way of thinking, you'll notice opportunities everywhere. You'll see how your skills can be packaged, how your savings can be invested, and how your time can be multiplied. The paycheck becomes just one small piece of your financial puzzle, not the whole picture. And from there, you're no longer chained to the cycle, you're building your way out of it. Chapter 3: Mastering Money, Budget, Debt, and Asset Allocation. Money is a tool, but for most people, it feels like money is the master. Every month, the paycheck arrives, the bills eat it up, and the cycle repeats. Escaping the middle class requires learning to control money instead of letting it control you. And that starts with 3 unshakable pillars: how you budget, how you handle debt, and how you allocate your money into assets that build wealth. Without these 3, no matter how much you earn, you'll always be stuck wondering where the money went. Budgeting is not about restricting your life. It's about directing your money with purpose. The average person spends first and then tries to save what's left over. That's why savings accounts stay empty. Wealth builders flip the formula: they pay themselves first. For example, if you earn $4,000, you decide ahead of time that $800 goes straight into investments or savings before you touch the rest. The remaining $3,200 covers your lifestyle. It feels hard at first, but over time you adjust. Most people think they need more income, but what they really need is control. A disciplined budget exposes the leaks you don't even notice: subscriptions you forgot about, impulse spending, unnecessary upgrades. Plugging those leaks gives you the capital to invest, and that's the first step to breaking free from living paycheck to paycheck. Let's get real. If you track your expenses for 1 month, you'll see how easy it is to waste money. That $5 coffee every workday, that's $100 a month, $1,200 a year. The takeout 3 nights a week, that could be another $300 a month. Add in unused subscriptions, random shopping, and lifestyle upgrades, and suddenly thousands are gone without adding value to your future. A simple rule is this: if it doesn't put money back in your pocket or improve your long-term well-being, think twice before spending. Budgeting isn't punishment, it's about creating freedom. Now let's talk about debt. Debt is one of the biggest traps keeping the middle class stuck. Credit card balances, car loans, student loans, they're like anchors dragging you down while you're trying to swim. But here's the key: not all debt is bad. Consumer debt, the kind you use to buy things that lose value, is poison. But strategic debt, the kind used to acquire income-producing assets, can be a weapon. For example, if you put $10,000 on a credit card at 20% interest, you're sinking fast. But if you borrow $10,000 at 5% interest to buy a vending machine business that makes $500 a month, you're turning debt into leverage. The wealthy understand this distinction. The middle class doesn't. If you're already buried in bad debt, the first move is simple: stop digging. Cut up unnecessary cards, stop financing depreciating items, and make a concrete payoff plan. The snowball method, paying off the smallest debts first, gives psychological wins and momentum. The avalanche method, paying off the highest interest debts first, saves you money in the long run. Whichever you choose, consistency matters more than perfection. Imagine freeing up even $400 a month from debt payments. That's money you can redirect into investments that actually work for you. Here's a story that shows how this shift works. Jessica was a teacher earning $50,000 a year, but drowning in $30,000 of credit card and student loan debt. She felt stuck. She created a zero-based budget, cut unnecessary expenses, and focused aggressively on paying down her highest interest debts. Within 3 years, she was debt-free. That same $600 she used to throw at credit cards, she started investing into index funds. Within another 5 years, her portfolio was worth over $50,000. Nothing magical happened. She just took control of her debt and redirected the same money into assets. That's the hidden path out of the middle class, transforming liabilities into wealth-building tools. Now we come to the most powerful concept, asset allocation. Once you've created space in your budget and freed yourself from destructive debt, the question becomes where to put your money. Middle-class people often save money in bank accounts, thinking it's safe, but inflation silently eats away at those savings every year. Wealth builders understand that money sitting idle loses power. They direct their money into different buckets, some for security, some for growth, and some for cash flow. Let's break it down. One part of your money should be in liquid assets, cash or equivalents, for emergencies. This prevents you from going back into debt when unexpected expenses hit. Another portion should be invested in growth assets like stocks, ETFs, or mutual funds, vehicles that grow in value over time. And then there's cash flow assets, real estate, businesses, dividend-paying stocks, things that put money in your pocket regularly. The exact percentages depend on your risk tolerance, but the point is clear: your money should always be working in different ways. Consider this example. Tom earns $5,000 a month. He decides to allocate 20% to investments. $500 goes into a stock index fund each month, $300 into a real estate crowdfunding platform, and $200 into building an online store. After 5 years, his index fund has grown to over $35,000 thanks to compounding. The real estate platform pays him steady dividends. His online store brings in an extra $500 monthly profit. None of this happened overnight, but by sticking to his allocation, Tom created multiple streams of wealth that no paycheck could provide. Another real-world principle here is the law of compounding. The earlier you start allocating money into assets, the faster it multiplies. A $200 monthly investment at a 10% return grows to nearly $380,000 in 30 years. That's money working harder than you ever could. People underestimate small, consistent investments because they want quick results, but wealth is built in decades, not days. The wealthy think in terms of generations, while the middle class thinks in terms of pay periods. That shift in vision is everything. One area people ignore is using the law to their advantage. Tax codes in almost every country reward investors and business owners. For instance, in the US, long-term capital gains are taxed lower than regular income. Retirement accounts like IRAs and 401ks give tax advantages for consistent contributions. Even rental property owners can legally deduct expenses like mortgage interest, maintenance, and depreciation. Knowing and using these laws can save you thousands every year, money that can be reinvested instead of wasted. Ignoring them is like leaving free money on the table. The mindset here is not just about budgeting, debt, or investments. It's about directing every dollar with purpose. A paycheck is just a starting point. What matters is how you allocate it. You either spend it on things that disappear or plant it into things that grow. One road keeps you middle class, the other sets you free. This transformation isn't about living like a monk. It's about making money serve you instead of the other way around. You can still enjoy life, but the foundation must be built first. Imagine the relief of knowing your rent is covered not by your labor, but by passive income from assets. Imagine your children inheriting not debt, but a portfolio that generates wealth long after you're gone. That's the future you create when you master money instead of letting money master you. The difference between those who stay stuck and those who escape is simple: clarity, discipline, and direction. Track where your money goes, Attack debt like your life depends on it, and redirect freed up cash into assets that multiply. Over time, you'll notice the shift. Less stress, more freedom, and opportunities opening that you never thought possible. That's how ordinary people step out of the middle class and into true financial independence. Chapter 4: Skill Stacking, Building High Income and In-Demand Abilities. If you want to escape the middle class, the truth is no one will hand you a higher income just because you show up. The people who rise above average don't rely on one skill alone. They stack skills in a way that multiplies their value. A single ability can get you a job, but a unique combination of abilities can make you irreplaceable, put you in demand, and allow you to charge more than anyone else around you. That's the secret the wealthy understand. Income isn't only about how hard you work, it's about how rare and valuable your skill set is. Think about the difference between someone who only knows accounting and someone who knows accounting, public speaking, and digital marketing. The first person might work quietly in the back office for a fixed salary. The second can manage finances, present ideas to investors, and bring in clients online. Who do you think gets paid more? Not because they work more hours, but because their value stretches across multiple areas. This is skill stacking in action, and it's one of the fastest ways to break free from stagnant income. Let's use a real example. Sarah started as a graphic designer. At first, she charged $20 an hour because design skills are common. Thousands of freelancers compete at the same rate. But she didn't stop there. She learned copywriting so she could write ad content, then picked up digital marketing so she could help businesses not only design ads, but also run campaigns that produced sales. Now she offers full service packages, design, copy, and marketing strategy. Instead of $20 an hour, she charges $5,000 per project. Same person, different stack of skills. That shift pushed her from middle-class income to wealth-building territory. This principle isn't limited to freelancing. Even inside traditional jobs, those who stack skills get ahead. Imagine an engineer who also understands project management, negotiation, and leadership. While other engineers stay stuck in technical roles, this one moves into management, gets promoted faster, and commands higher salaries. The job market rewards the people who solve bigger problems, and you solve bigger problems when you combine multiple skills. One mistake many people make is believing that specializing in one thing forever is the safest bet. But in today's world, industries change too fast. Entire professions that once seemed untouchable have been replaced by software or cheaper global competition. If you only have one skill, you're vulnerable, but if you stack, you're adaptable. You can pivot, reinvent yourself, and stay relevant no matter what happens to the economy. The law of supply and demand plays here too. If your skill is common, the market dictates your pay. If your skill stack is rare, you dictate your pay. Think about someone who can code, sell, and lead a team. There are plenty of coders, plenty of salespeople, and plenty of managers, but very few who can do all three. That rarity makes them expensive, and companies or clients will pay a premium because replacing them would require hiring 3 different people. That's how you flip the script and put yourself in control. Now let's make this practical. You don't need to master 10 things at once. Start with what you already know and add layers. If you're good at writing, learn public speaking. If you're in sales, learn digital marketing. If you're technical, add leadership and communication. Every new layer multiplies the previous one. This isn't about becoming average in many areas. It's about being good enough in each to create a combination that few others can match. Consider the story of John. He was a school teacher, stuck at $45,000 a year. Instead of staying there, he decided to learn video editing. With that skill, he started tutoring students online and editing his own educational content. Then he learned how to market those videos on social media. Within 3 years, John was making 6 figures, not from his teaching job, but from his online education business. Teaching was his base, video editing was his second skill, and marketing was his third. That stack transformed his life completely. Another angle to consider is negotiation. Most people accept whatever salary or rate is offered, but add negotiation to your skill stack, and suddenly every opportunity becomes more profitable. If you can confidently present your value, demonstrate results, and negotiate terms, you can turn average deals into great ones. That's not luck, that's strategy. The difference between earning $60,000 and $90,000 can sometimes come down to whether you know how to negotiate effectively. The internet makes skill stacking easier than ever. You don't need a new degree or years in school. You can learn coding on free platforms, master copywriting through online courses, practice public speaking through local clubs, or build marketing knowledge by testing ads with small budgets. The barrier to entry has never been lower. The challenge isn't access, it's discipline. Most people scroll for entertainment instead of building skills that could change their future. And here's something powerful. Skills compound, just like money does. At first, adding a new ability feels slow, but once you have 3, 4, 5 skills working together, your opportunities multiply. Each skill amplifies the others, and suddenly you're operating on a level where very few competitors exist. That's when you can charge more, choose your projects, and stop being controlled by a paycheck. This is also where law and business intersect. In many industries, certifications or licenses create barriers to entry. If you understand the legal requirements, you can position yourself above others who don't. For example, a real estate agent with a basic license earns commissions, but an agent who also learns digital advertising, negotiation and investment law can dominate the market, attracting investors and developers instead of just casual home buyers. Same industry, different results, all because of stacked skills. To illustrate further, imagine you're in IT. You know how to manage networks. That's good, but lots of people can do that. Now you learn cybersecurity. Suddenly, your value doubles. Add communication skills so you can explain risks to executives in plain language. Now you're the person the CEO trusts in critical meetings. Learn leadership and you're promoted to head of IT. One skill started the journey, but the stack created the leap. If you're wondering where to start, look at the skills that make money across industries: communication, sales, leadership, marketing, technology, and finance. Pair those with your existing strengths, and you've got a winning formula. For example, if you're creative, add sales. If you're analytical, add communication. If you're technical, add leadership. The best income jumps happen when you combine opposites. Let's not forget entrepreneurship. The biggest winners aren't just skilled, they know how to combine those skills into ventures. Someone who understands design, branding, and e-commerce can launch their own product line. Someone with finance, marketing, and leadership can build a startup. The wealthiest people in the world rarely rely on one ability. They build stacks that make them unstoppable. Here's the takeaway. You don't need to be the best in the world at any single skill. You just need to be in the top 25% at several and know how to combine them. That's enough to put you in a category of one, where you're not competing on price but on value. Employers, clients, and markets will chase you because they can't find your exact mix anywhere else. Escaping the middle class isn't about grinding harder at the same job. It's about increasing your value to the point where you're no longer replaceable. And the fastest way to do that is by stacking skills deliberately, patiently, and strategically. Every new skill you add is another key that unlocks doors the average person will never even see. Chapter 5: Ownership over Labor, Creating Assets that Work for You. Most people spend their entire lives trading hours for dollars, believing that if they just work harder, save more, and maybe climb the corporate ladder, financial freedom will come. But here's the harsh reality. No matter how much you earn from a job, you're still renting your time. The moment you stop working, the income stops flowing. That is the middle class trap. And the only way out is to own assets that generate money even while you sleep. Ownership, not labor, is what separates the wealthy from everyone else. Think about this. The janitor and the CEO both have 24 hours in a day. The difference is the janitor trades hours for wages, while the CEO owns equity, stock options, or an entire company that pays even when he's on vacation. The wealthy don't rely on sweat alone. They own systems, real estate, businesses, and digital assets that multiply without constant effort. That's why someone making $50,000 at a job might never build real wealth, while someone who owns a small rental property or an online store can see their income snowball year after year. Let's take real estate. If you own a house you live in, that's not an asset. It's a liability because it costs you money every month. But if you buy a rental property that covers its mortgage and leaves extra cash flow, that's ownership paying you back. Imagine having 3 rental units that each bring $500 net income monthly. That's $1,500 every single month without clocking in. Over a year, that's $18,000. That's the power of moving from labor to assets. The same goes for digital assets. In today's world, you don't need millions in capital to own something valuable. You could create an online course once and people can buy it for years. You could publish a book on Amazon, build a YouTube channel, or launch an e-commerce brand. These digital assets are like seeds. You plant them once, water them with consistent effort at the start, and then they continue to grow while you're free to build more. Here's a story that proves this. David worked as an IT technician. He made decent money but was always tired and stuck in the cycle of paycheck to paycheck. He decided to build a mobile app during his free time. At first, it brought in only $50 a month. Not much, right? But he kept improving it, marketed it properly, and within 3 years, the app was generating $3,000 every month. That's more than some people make in a full-time job. David still worked his 9 to 5, but the app gave him options, freedom, and eventually the confidence to leave his job entirely. He stopped renting his hours and started owning digital property. This shift is not just financial, it's psychological. When you only trade time for money, you become cautious, protective, and afraid of losing that paycheck. But once you build assets, your mindset expands. You stop worrying about layoffs or missing overtime because you know your money is working for you. That confidence changes the way you approach everything, from investments to lifestyle to family security. Ownership also taps into legal and tax advantages. Employees get taxed the highest because the government taxes wages before you even see them. Business owners, landlords, and investors, on the other hand, have legal ways to reduce taxes. They can deduct expenses, write off depreciation, reinvest profits, and grow wealth faster. For example, if you earn $70,000 from a job, most of that is taxable. But if you own a business, you can reinvest profits into growth, legally pay fewer taxes, and end up keeping more of your income. That's a law of money most people ignore, and it's why business owners scale faster than employees. Think about Warren Buffett. He doesn't clock into a job. He owns shares in companies. Those companies work around the clock, generate profits, and send him dividends. Elon Musk doesn't earn a paycheck like a middle manager. He owns Tesla and SpaceX shares, even on days he doesn't step foot in the office. Billions are at work for him. That's the ultimate level of ownership, and while we don't all start at that scale, the principle applies at every level. Ownership doesn't have to be massive to be life-changing. Imagine building a YouTube channel that earns $500 a month. That might sound small, but that $500 is equal to having $50,000 invested at a 4% return. One small digital asset equals what many people save their entire lives for in retirement. Multiply that by several projects, and suddenly you've bought back your time. The trap most middle-class people fall into is lifestyle inflation. Every time they earn more, they spend more. New car, bigger house, fancy vacations. But the wealthy use extra income to acquire assets. Instead of buying liabilities, they buy rental units, dividend-paying stocks, or online businesses. Over time, those assets buy them everything else. That's why the middle class stays stuck and the wealthy keep climbing. To make this practical, you need to ask yourself, what can I build or own that pays me repeatedly? If you're skilled in something, package it into a course or write an ebook. If you have savings, instead of letting them sit in a low-interest account, look into real estate or index funds. If you enjoy content creation, build a blog, podcast, or YouTube channel that can be monetized. If you have a knack for business, start something small and reinvest the profits. The goal is always the same: create income that doesn't rely on your daily labor. Here's another real-life illustration. Emily worked as a nurse. She loved her career, but felt stuck financially. Instead of picking up more shifts, she and her husband bought vending machines. They placed them in schools and gyms. Within a year, the machines were bringing in $1,200 a month after costs. It wasn't glamorous, but it was steady. That small step into ownership opened their eyes, and later they scaled into owning a small laundromat. Today, Emily still works as a nurse, but she has multiple income streams that will support her even if she stops working tomorrow. This is the transition you must make. From relying on labor to owning things that produce. It won't happen overnight, but every step toward ownership compounds. Your first rental unit, your first side business, your first digital product. They're like bricks building a foundation of freedom. One day you'll wake up and realize you're no longer trapped by a paycheck, because your assets have replaced the need for constant work. The question is, will you keep selling your hours forever, or will you start owning things that pay you regardless of time? The choice determines whether you stay in the middle class or escape it entirely. Wealthy people understand one rule above all: if you don't own, you'll always be owned. Chapter 6. Multiple streams of income. Beyond the 9. Most people believe a single paycheck is enough to build a comfortable life, but the truth is that relying on one income source is one of the fastest ways to stay trapped in the middle class. Life is unpredictable, jobs disappear, industries evolve, and unexpected expenses hit when you least expect them. The reality is simple: if you want financial freedom, you cannot depend on one source of income. The solution is creating multiple streams of income, where money comes from different places, some requiring effort and some flowing in passively, allowing you to live and grow without constantly trading hours for dollars. Think about it this way: if your job disappears tomorrow, how long could you maintain your lifestyle? For most middle-class workers, the answer is frighteningly short: weeks or months at best. But someone with multiple income streams has safety nets. Even if one source dries up, Others keep the cash flowing. That's why diversifying income isn't just a strategy, it's survival. Take real estate, for example. A rental property can produce steady monthly cash flow, while your primary job still provides stability. Add a digital product or an online course, and suddenly your earnings aren't tied to your presence or hours worked. Let's look at a real-life scenario. Carlos worked as a logistics manager, earning $60,000 a year. He was tired, stressed, and realized he was vulnerable because all his money came from one employer. Carlos started small. A weekend dropshipping store. The first few months were slow, barely earning $50, but he learned the ropes of e-commerce. Then he reinvested profits into another store, launched a small YouTube channel to promote his products, and finally experimented with print-on-demand merchandise. Within 2 years, Carlos was making $3,500 a month in side income, completely separate from his day job. That wasn't luck. It was persistence, experimentation, and building multiple revenue streams. The key to creating multiple streams is understanding that not all income is equal. Active income, the kind you earn by trading hours for dollars, is necessary to get started. But passive income is where the magic happens. Passive income doesn't mean doing nothing, it means setting up systems once that keep producing money repeatedly. For example, you could write a book today, and months later it's still selling, generating royalties while you sleep. You could invest in dividend stocks and receive quarterly payments without lifting a finger. You could build an online membership or subscription service that automatically bills clients every month. The effort is upfront, but the return lasts indefinitely. Many people hesitate because they think building multiple income streams requires massive capital or a fancy degree. It doesn't. You start with what you know and scale. If you're a skilled cook, you can sell meal prep services. If you're tech-savvy, start an online course or freelance consulting. If you have creativity, design merchandise or start a YouTube channel. The initial income might be small, but consistent effort and learning will make it grow exponentially. This is the principle of leverage. One skill or asset can produce income far beyond what a single job can offer. Here's another story. Anita was a school teacher. She loved teaching, but hated being trapped by one salary. She started tutoring online for extra income, then created worksheets and lesson plans to sell digitally. Within a year, her tutoring and digital sales matched her teaching income. She didn't quit her job. She used it as stability while growing new streams. That's the safe way to scale. Keep your base income while diversifying. Once the side incomes grow enough, you can decide whether to leave the job or keep it for security. Legal structure is another advantage that often gets overlooked. Multiple streams allow you to leverage tax laws and regulations to your benefit. Business income can be reinvested, deductions can be claimed, and assets can grow tax efficiently. Unlike a single paycheck, where most of your earnings are taxed immediately, properly structured side businesses, rental properties, and investments can reduce taxable income legally while expanding wealth. Understanding how the law treats different income types is as important as creating the streams themselves. It's also important to mix active and passive sources strategically. Active income helps you invest in passive sources. Passive income frees time to pursue new active opportunities that can grow into additional streams. For example, a graphic designer could continue freelance work while creating design templates to sell online. Freelancing produces immediate income, while the templates continue earning long after the work is done. Over time, more and more passive streams reduce reliance on any single active income source, giving flexibility, security, and freedom. The middle class often believes that side hustles are optional or just hobbies. That mindset is dangerous. Side hustles aren't just extra money, they're stepping stones to independence. Even small amounts of supplemental income, when reinvested wisely, can snowball into substantial wealth over time. Compound growth works not just for investments, but also for income streams. A $200 a month side income reinvested into a high-growth asset can exceed a decade of stagnant salary growth. That's leverage in practice. Another practical example is Brandon, a construction worker. He made $45,000 a year and lived paycheck to paycheck. He started flipping furniture as a side hustle, learning carpentry upgrades, marketing them on social media, and selling for a profit. Each month, he reinvested earnings into more materials and tools. Eventually, Brandon had multiple small ventures, refurbished furniture sales, online DIY tutorials, and consulting for home improvement projects. Combined, these streams outpaced his day job. He didn't need to quit. He expanded his financial footprint without increasing stress. That's the essence of diversifying income, using multiple smaller streams to build a larger financial ecosystem. The mindset to embrace here is critical. Instead of asking, "How much do I earn per hour?" start asking, "How many streams of income do I have, and how can I increase them?" Every skill, hobby, or asset you own can be turned into an income stream if you apply creativity and consistency. It's about moving from scarcity thinking, one paycheck, one job, one source, abundance thinking, multiple flows, multiple opportunities, multiple safety nets. You also need to consider scalability. Not all streams grow automatically. You must identify which streams can expand without requiring more hours. Online businesses, investment portfolios, digital content, or real estate allow you to scale in ways that a single job cannot. By contrast, working 2 or 3 extra jobs simply trades more time for money. It's not scalable. True wealth comes from streams that multiply independently of your labor. The most important principle is starting now. People often wait for the perfect time or more money to invest. The reality is that the first step is always imperfect, small, and messy. A $50 a month experiment in a side hustle is better than waiting for $5,000 that may never come. Starting builds skill, discipline, and momentum. Every stream you add compounds with the previous ones, eventually creating a network of income that supports freedom, growth, and opportunity. By developing multiple streams of income, you don't just make money, you buy options, flexibility, and security. You reduce dependence on one employer, one client, or one industry. Emergencies, economic shifts, and life changes become manageable. More importantly, your mindset shifts. Instead of worrying about bills, you start thinking about how to grow, invest, and create long-term wealth. The middle class survives paycheck to paycheck. Those who embrace multiple streams thrive, innovate, and eventually escape the cycle entirely. Chapter 7. Smart Investing, Turning Savings into Generational Wealth. Most middle-class people are excellent at earning money, but terrible at making money work for them. They save a little, spend a little, and hope for the best, assuming that time alone will solve everything. The wealthy understand a different principle. Money can grow exponentially if you place it in the right hands, in the right vehicles, and with patience. That is the secret behind turning savings into generational wealth. The ability to compound, invest smartly, and diversify into assets that produce more than just interest in a bank account. Let's start with compounding because it's the foundation. Imagine putting $200 a month into a conservative investment that earns 8% annually. That doesn't sound like much, right? But in 30 years, that same $200 grows into over $200,000. That's not your effort increasing, it's your money multiplying. Albert Einstein called compounding the eighth wonder of the world, and he wasn't wrong. Most middle-class earners overlook this because they are consumed by immediate gratification. They'd rather buy a new car or the latest phone than plant seeds that will grow for decades. Stocks are one of the most accessible ways to build wealth if approached intelligently. Buying shares of companies isn't gambling, it's buying ownership in something real. Historically, stock markets have returned 7 to 10% annually, adjusted for inflation. That's higher than any savings account or fixed deposit. The trick is consistency and patience. You don't need to pick the next big thing or time the market perfectly. Instead, regular investments in diversified portfolios, index funds, or ETFs over years create significant growth. The middle-class habit of checking accounts monthly and withdrawing money destroys potential gains. The wealthy invest for decades, and that patience compounds into fortunes. Real estate is another pillar. Many think real estate requires huge capital, but strategies exist for almost any budget. You can start with a small rental property, a duplex, or even real estate crowdfunding. Each property produces rental income, which can be reinvested, and property values tend to appreciate over time. Combine that with the power of leverage, using borrowed money to acquire property, and suddenly you're growing wealth far faster than saving alone could achieve. A middle-class worker renting their home builds nothing. A property owner generates income and equity simultaneously. Alternative assets should also be considered for diversification. Commodities, peer-to-peer lending, and certain collectibles can act as inflation hedges or provide additional revenue streams. Diversification isn't about avoiding risk completely, it's about managing it smartly. The wealthy don't bet everything on one horse. They spread capital across different assets that respond differently to economic conditions. This ensures that even if one asset underperforms, others compensate. Let's take a practical example. Jessica saved $15,000 over 5 years from her teaching job. Instead of letting it sit in a savings account earning 1% interest, she diversified. She put $5,000 into an index fund, $5,000 into a rental property down payment, and $5,000 into a peer-to-peer lending platform. Within a decade, her index fund doubled, her property's value appreciated by 30%, and her lending platform generated steady passive returns. That $15,000 turned into a combination of cash flow and asset growth worth more than $50,000, all because she understood compounding and allocation. Smart investing is also about risk management. High returns are tempting, but they often come with higher volatility. Middle-class investors make the mistake of chasing hype, cryptocurrencies, hot stocks, or trendy real estate markets without understanding the mechanics. Wealth is built slowly, not through speculative gambles. Diversified investments, legal protections, and informed decision-making reduce risk while allowing for steady growth. Education is key. The more you understand an asset, the more control you have over your future. Taxes are another overlooked factor. Middle-class earners pay heavily on wages, but investment income often enjoys preferential treatment. Dividends, long-term capital gains, and certain real estate deductions can drastically improve net returns. Understanding tax law is as important as picking assets. For example, a $100,000 gain in a job paycheck may leave you with $70,000 after taxes, while a $100,000 gain from long-term investments may only reduce to $85,000. Knowledge of law and financial structures separates passive wealth builders from those stuck earning active wages alone. Consider the story of Tom. He earned $80,000 a year as an engineer, saved diligently, and invested slowly. He learned about index funds, started buying rental properties, and reinvested every dividend and rent payment. 15 years later, his passive income exceeded his active income, giving him freedom to scale new businesses, travel, and invest further. The key wasn't that he earned more than others, it was that he invested wisely and consistently. That's the principle anyone can replicate. Let money do the heavy lifting while you focus on growth. Another aspect is generational wealth. Investing isn't just about creating comfort for yourself. It's about leaving an inheritance of assets that continues to grow. Stocks, properties, and other investments pass wealth to children, grandchildren, or causes. The middle class often accumulates debts and liabilities that die with them, leaving no lasting legacy. The wealthy plan transfers, trusts, and structures to ensure compounding continues across generations. That's why investing strategically isn't just about money, it's about power, security, and legacy. Starting small is essential. You don't need $1 million to begin investing. Even modest monthly contributions, disciplined over decades, grow far beyond expectations. Middle-class people often wait for enough money to start, but the key is time, consistency, and compounding. Start with what you have, learn about asset classes, and allocate gradually. Mistakes early on are lessons, not disasters. Each dollar invested intelligently now buys freedom later. The psychological shift is critical. Saving money alone isn't enough. You need to see savings as seeds, investments as the soil, and time as the sunlight. Middle-class earners often store money like it's a trophy, not a tool. Wealthy individuals actively deploy capital, monitor growth, adjust strategies, and multiply it systematically. That is the mindset of generational wealth, deliberate, informed, and patient. Finally, smart investing ties together all the previous steps: mindset, skill stacking, ownership, and multiple income streams. Money is a tool, but like any tool, its value depends on how you use it. A diversified, disciplined, and informed investment strategy turns ordinary savings into extraordinary growth. Compounding, asset allocation, risk management, and understanding legal and tax advantages create a system where money works for you, not the other way around. This is the difference between surviving in the middle class and thriving beyond it. Chapter 8: Power of Proximity, Networking with Winners. If you want to escape the middle class, one of the most overlooked strategies isn't money, skill, or even hard work, it's proximity. Who you spend your time with determines how far you go in life. The truth is brutal. If you surround yourself with people who think small, act cautiously, and accept mediocrity, you will absorb those same limits. On the other hand, if you intentionally position yourself near winners, mentors, investors, entrepreneurs, and high achievers, you begin to think differently, act differently, and make decisions that multiply your chances of success. Let's face it, most middle-class circles reinforce the status quo. Conversations revolve around complaints, bills, and incremental improvements rather than opportunity and exponential growth. You might work hard, save diligently, and even invest wisely, but if everyone around you believes the 9-to-5 grind is the ultimate goal, your thinking will remain capped. You're being unconsciously trained to conform. Breaking free requires deliberate action, seeking environments where ambition is the norm, not the exception. Think about the law of association. Humans are social creatures, and our habits, ideas, and even financial behaviors are shaped by those we interact with regularly. If you spend 10 hours a week with people who constantly discuss small setbacks, you begin to internalize a fear of risk. Conversely, if you dedicate those same hours to interacting with investors, business owners, or self-made individuals, you start seeing opportunities where others see obstacles. That shift alone is worth more than any course or investment, because it rewires how you evaluate life and money. Take Maria's story. For example, she was an accountant earning a decent salary, but living paycheck to paycheck. She noticed her friends rarely discussed growth or wealth creation. They were focused on weekend shopping and vacations. Maria decided to attend local entrepreneur meetups and joined an online investment mastermind group. The people she met shared strategies for real estate deals, stock investments, and business ventures. Within months, she was co-investing in a small property with one of her new contacts. A year later, her portfolio had grown enough that she was no longer fully dependent on her accounting job. The people she chose to surround herself with accelerated her financial growth. Network is more than handing out business cards or attending conferences. It's about cultivating relationships with people who challenge your thinking, push you to take calculated risks, and offer insight you wouldn't discover alone. A casual chat with someone who's done what you aspire to achieve can save years of trial and error. Mentors not only provide guidance, they open doors to opportunities, partnerships, and capital that are otherwise inaccessible. Middle-class thinking often assumes you can achieve everything alone. The truth is, leverage comes not only from money but from relationships. Investors are another critical component. If you want to escape the middle class, you need access to capital, and you rarely accumulate enough alone, especially early on. Being close to investors, even on a learning level, allows you to understand what they look for, how they evaluate risk, and how deals are structured. This knowledge is invaluable when you want to create assets, start businesses, or fund real estate ventures. Even a casual conversation with a seasoned investor can shift your mindset from "I can't afford it" to "I can structure this deal to minimize risk and maximize returns." High achievers also model behavior in ways that are often invisible but highly impactful. It's not just what they say, it's how they think, how they make decisions under pressure, and how they manage failures. Spending time with people who have successfully navigated challenges allows you to observe strategies you can't learn from books alone. You start adopting their mental models, risk tolerance, and problem-solving techniques. Slowly, these habits become part of your own behavior. Here's a practical approach. Identify the top 1–2% of people in your desired field, in your community, or online. Engage them genuinely, seek advice, offer value, and ask thoughtful questions. Avoid transactional thinking, where you only approach someone when you need something. Real mentorship is built on trust, reciprocity, and consistent interaction. The more you immerse yourself in their world, the more your thinking aligns with theirs, and the faster you elevate your own life trajectory. Another example is Kevin, a software engineer. He earned a good salary, but felt stuck. Kevin intentionally joined a startup accelerator community, where he met founders, investors, and serial entrepreneurs. He spent hours learning their processes, attending workshops, and absorbing lessons from their failures and wins. Within 2 years, he co-founded a tech startup with contacts from that community. That venture, combined with strategic investments advised by his mentor, allowed him to leave his corporate job and scale income far beyond his previous salary. His proximity to winners made the leap possible. Even family can influence your financial trajectory. Many middle-class individuals come from households where discussing risk, investing, or entrepreneurship is taboo. That doesn't mean you can't break free, but it does mean you must consciously create new circles that expand your perspective. Surround yourself with people who inspire action, reward creativity, and normalize wealth-building behaviors. One practical tip is to mix physical and digital proximity. Attend conferences, workshops, and networking events in your city. Simultaneously, Join online communities of professionals and investors in your niche. Social media can be a powerful tool if used correctly. Follow leaders, engage with thought-provoking content, and participate in discussions. These virtual interactions can often lead to real-world collaborations and partnerships, even before you meet face-to-face. Remember, it's not just about knowledge, it's about momentum. Being around winners pushes you to act, to experiment, and to take calculated risks you would otherwise avoid. That momentum compounds over time. Each connection, insight, and collaboration accelerates your journey out of the middle-class mindset. The law of proximity works subtly but powerfully. Your network becomes a mirror reflecting what's possible, not what's probable. Legal awareness also plays a role here. When you're close to investors and mentors, you learn the legal frameworks around investments, contracts, and business structures. Knowing how to legally protect your interests, structure partnerships, and minimize liability is knowledge often gained through guidance, not textbooks. That insight can prevent costly mistakes while maximizing returns on opportunities that would intimidate a lone middle-class worker. Ultimately, the message is clear. Your network is your net worth. Skill, money, and effort matter, but without proximity to the right people, your growth is limited. Winners open doors, provide insight, and model behaviors that accelerate success. Middle-class earners often fail because they assume financial freedom is achieved in isolation. The wealthy know that the fastest path to growth is strategic relationships combined with relentless learning and action. Chapter 9. Time leverage. Systems, automation, and delegation. Most middle-class people are trapped not just by money, but by time. They wake up, commute, work long hours, come home exhausted, and repeat the cycle day after day. Even when they earn more, their schedules remain crowded, leaving little space to build wealth, develop skills, or pursue opportunities. Escaping this trap requires a shift from trading hours for dollars to leveraging time through systems, automation, and delegation. The wealthiest people don't work harder, they make their time work for them. Time leverage starts with identifying low-value tasks. These are activities that consume hours without creating significant returns, whether in income, skill growth, or opportunity. Examples include excessive email checking, manual administrative work, repetitive data entry, or trying to handle everything yourself in a business. Most middle-class individuals treat these tasks as necessary, failing to see that they drain energy and reduce capacity for higher value activities. The first step is ruthlessly prioritizing what matters and eliminating or delegating the rest. Consider the example of Laura, a small business owner. At first, she managed every aspect of her online store herself: product listings, customer emails, social media, inventory tracking. She worked 60-hour weeks and barely made progress. Then she learned about automation tools for email responses, scheduling software for social media, and hired a virtual assistant to manage inventory and shipping. Suddenly, Laura freed up 20 hours a week. That time was reinvested into target development, marketing strategy, and building new revenue streams. By leveraging systems and delegation, her business scaled far faster than manual effort ever could. Automation is one of the most powerful tools for multiplying output without multiplying hours. In today's digital world, nearly every repetitive task can be automated. Invoices, client follow-ups, social media posts, even parts of customer service can be handled by software or AI tools. Middle-class workers often resist automation, seeing it as expensive or unnecessary, when in reality, the time saved quickly pays for itself. Imagine automating a process that takes 5 hours a week over a year. That's 260 hours, equivalent to more than 6 40-hour work weeks, reclaimed for wealth building. Delegation goes hand in hand with automation. The wealthy know they cannot do everything themselves and focus only on tasks that utilize their unique skills and generate the most value. Everything else, bookkeeping, routine emails, minor client communications, or even content creation, can be outsourced. Delegation isn't a sign of laziness. It's a strategic choice to expand capacity. Middle-class earners often believe they must do it all to maintain control, but that mindset limits growth. True leverage comes from aligning effort with impact. Let's take the story of Raj, a software consultant. Initially, Raj coded every project himself, burned out, and capped his earnings. He realized his time was the bottleneck. He hired junior developers and created standardized coding templates. Now Raj supervises, guides, and sells solutions, while his SANE handles execution. His effective hourly rate multiplied without him working more hours. That's time leverage, turning a single person's effort into the output of a team without directly trading more time. Systems are the foundation of this approach. They turn repeated actions into predictable outcomes without constant oversight. For instance, a sales funnel for a business or an investment tracking system for a portfolio creates structure and efficiency. Once established, these systems free mental energy, reduce mistakes, and ensure consistency. Wealth isn't built by working harder on random tasks. It's built by having reliable processes that keep producing results with minimal intervention. Middle-class people often fear delegation and automation because of perceived loss of control or quality. The solution is not to abdicate responsibility entirely, but to set clear guidelines, expectations, and feedback loops. This ensures standards are met while still freeing up your time for higher leverage activities. For example, instead of answering every client inquiry yourself, you can create standardized responses, train an assistant, and review exceptions. The result is more time, less stress, and more opportunities to grow wealth. Another practical example is Jake, a real estate investor. Initially, he managed all rental properties manually, collecting rent, handling maintenance calls, screening tenants. The workload capped how many properties he could own. Once he implemented property management software and hired a property manager, he expanded to 15 units, instead of the 3 he could handle alone. His income multiplied, but his personal time remained intact. That's the power of time leverage, expanding capacity without burning out. Time leverage also includes personal productivity. The wealthy protect their focus ruthlessly. Meetings, emails, and minor tasks are scheduled strategically or eliminated. They batch similar tasks, use productivity tools, and guard their most creative, strategic hours for wealth building. Middle-class workers, by contrast, are reactive, responding to every interruption and squeezing high-value tasks into fragmented minutes. The difference compounds over months and years, leading to exponentially greater results for those who manage time intentionally. Even legal and financial systems benefit from time leverage. A well-structured business entity can reduce paperwork and simplify tax obligations. Automated accounting software tracks income, expenses, and compliance, freeing hours spent on manual bookkeeping. Investors leverage advisors, CPAs, and legal teams to ensure that asset management, contracts, and regulations are handled efficiently. Middle-class individuals often attempt to do all this themselves, losing precious time and increasing the likelihood of costly mistakes. The mental shift required for time leverage is significant. It requires letting go of the illusion that personal effort is the only path to results. Instead, focus on multiplying impact. How can a single hour of your energy generate 10 hours of output or even more? Automation, delegation, and systems turn this principle into reality. Your income, business and investments grow not linearly, but exponentially as your time is freed from low-value work. Time leverage compounds over the long term. If you reclaim 5 hours a week through delegation and automation and dedicate that to building skill stacks, side hustles or investments, the results multiply year after year. 1 hour saved today may produce hundreds or thousands of dollars in future wealth. The middle class ignores this principle, trapped by busyness. The wealthy use it deliberately, strategically, and relentlessly. Even hobbies, personal learning, and family time benefit from time leverage. By systematizing tasks and outsourcing what isn't high value, you create space to focus on personal development, networking, and wealth-building strategies. This is the difference between a life of constant grind and a life of strategic growth. Ultimately, mastering time leverage isn't optional. It's a necessity if you want to escape the middle class. It's not about working less aimlessly. It's about multiplying the impact of every action. Systems, automation, and delegation allow you to focus on what truly moves the needle, creating assets, investing wisely, building skill stacks, networking with winners, and pursuing opportunities that create lasting wealth. The question to ask yourself is this: how much of your time is truly yours, and how much is trapped in low-value tasks that someone else could handle? Every hour you free is an hour that compounds into income, opportunities, and freedom. Those who master this principle rise above the middle-class ceiling, not through luck, but through deliberate and intelligent leverage. Chapter 10. The Financial Freedom Blueprint. Designing your rich life. Imagine waking up tomorrow and realizing that your financial life is no longer dictated by paychecks, bills, or deadlines. You're free to make decisions based on opportunities, not obligations. This is the ultimate goal of escaping the middle class, financial independence. But it doesn't happen by accident. It's the result of a carefully designed blueprint that combines mindset, strategy, and action, the kind of roadmap that guides ordinary earners to extraordinary results. First, you need absolute clarity on where you are and where you want to go. Many middle-class earners drift through life, assuming that hard work and time alone will eventually lead to wealth. The problem is that enough is never defined, and without measurable goals, money flows out as quickly as it comes in. Start by defining a target. What does financial freedom mean to you? Is it enough passive income to cover all living expenses? Is it the ability to retire early, travel, or pursue passion projects without stress? Get precise. Write down a number, a lifestyle, and a timeline. This becomes your North Star. Next, assess your current financial reality. Track every dollar of income, expenses, assets, and liabilities. Most people think they're saving enough, but when you map it out, they're barely breaking even. Understanding your starting point is crucial. It shows the gaps, inefficiencies, and opportunities that can be turned into leverage. For example, you may discover that $500 per month is wasted on unnecessary subscriptions or interest payments. Redirecting even a portion of that toward investments or side hustles compounds over time, accelerating your journey. Once clarity and assessment are in place, the blueprint shifts to building assets. This is where everything you've learned, skill stacking, multiple income streams, and time leverage, comes together. Assets are the engines of financial freedom. They produce income without constant supervision, and the more diverse your asset base, the faster you break free from paycheck dependency. Real estate, digital products, small businesses, and investment portfolios are the backbone. Each one contributes to a cumulative effect. Income that grows even when you're not actively working. Parallel to asset building is the discipline of smart investing. Every dollar you save should be deployed strategically. Index funds, dividend stocks, real estate or alternative assets provide compounding growth. Avoid parking money in low-yield accounts that stagnate. Legal structures, tax planning, and professional advice further amplify results. The wealthy don't just save, they actively manage, structure, and grow their money within the legal framework to maximize efficiency. This isn't complicated, it's deliberate. Networking remains a critical element in this blueprint. Surround yourself with mentors, investors, and high achievers. Financial freedom isn't achieved in isolation. A single conversation with a seasoned entrepreneur or investor can open doors to opportunities, partnerships, or capital that years of solo effort can't. It's not just the connections, it's the mindset, insight, and accelerated learning that proximity to winners provides. Equally important is mastering your mindset. Fear, procrastination, and self-doubt are the silent killers of financial independence. Most middle-class earners allow uncertainty to dictate decisions, avoiding risk, sticking to safe jobs, and delaying investment. Freedom requires courage, calculated risk-taking, resilience in failure, and the patience to allow compounding to do its work. Mental toughness and discipline are as crucial as any investment or business venture. Time leverage plays a pivotal role in the blueprint. Freeing yourself from low-value tasks through systems, automation, and delegation allows focus on wealth-building activities. Your hours are finite. If you spend them on repetitive or low-return work, financial freedom will remain elusive. Automate processes, delegate responsibilities, and strategically prioritize high-impact tasks. Each hour reclaimed is an hour that multiplies wealth through skill application, investment, or entrepreneurship. Another critical step is scaling income streams. Financial freedom isn't achieved by a single income source, no matter how high. It comes from layering multiple streams, active and passive, that feed into your financial ecosystem. Start small with side hustles, then reinvest earnings into scalable ventures. The goal is that by the time you leave your 9-to-5, your alternative income streams exceed your living expenses, creating security and freedom simultaneously. Let's put this into perspective with a real-life example. Sarah was a mid-level manager earning $65,000 a year. She wanted more freedom but felt trapped. She started by saving aggressively and cutting unnecessary spending. She learned digital marketing and launched an online course, generating $500 per month initially. She purchased a small rental property using savings and financing, producing $800 monthly net income. Over 5 years, her portfolio expanded into multiple rentals, a growing online business, and a diversified investment account. Today, her passive income exceeds $7,000 per month, giving her the choice to work, scale, or explore life freely. The blueprint worked because she followed each step strategically, not randomly. Legal and structural planning is also vital in the final design. Business entities, trust funds, and investment accounts ensure protection, tax efficiency, and continuity. This creates a system where wealth isn't just earned, it's preserved and multiplied. Most middle-class individuals neglect this and watch hard-earned money erode through taxes, poor asset protection, or mismanagement. The blueprint prevents this by incorporating legal foresight from day one. Accountability and review complete the process. Even the best designed plan fails without regular monitoring. Track income, expenses, growth of assets, and progress toward goals. Adjust when necessary but avoid emotional, reactive changes. A disciplined, data-driven approach ensures momentum continues even during setbacks. Middle-class earners often give up at the first hurdle. Financially free individuals persist, adapt, and consistently move forward. Finally, the financial freedom blueprint isn't theoretical, it's actionable. It combines clarity, disciplined assessment, asset building, smart investing, networking, mindset mastery, time leverage, income diversification, and legal strategy. Each element reinforces the others. Missing one creates gaps, while integrating all creates a self-sustaining system. Financial freedom becomes inevitable when the blueprint is applied consistently over time. Ask yourself, have you defined your freedom? Have you assessed your current reality? Are you building assets, investing intelligently, leveraging time, and surrounding yourself with winners? Each step brings you closer to escaping the middle-class cycle. Your blueprint is your roadmap, your strategy, and your commitment to living life on your terms. This isn't about luck or inheritance. It's about design, discipline, and relentless execution. By following the blueprint, you transform from someone trapped by paychecks to someone who controls time, opportunity, and money. This is the ultimate payoff of escaping the middle class, a life where freedom, choice, and wealth are not aspirations, but daily reality.